Imagine waking up to a world where everything you thought you knew about money, value, and security suddenly changes overnight. That's the shock that's coming, and the hints of it have already leaked out. Just 2 minutes ago, whispers about the Federal Reserve's next move began to ripple across financial circles, and the core of the revelation points directly at gold and silver. For decades, these metals have been seen as relics, insurance policies at best, ignored by mainstream finance until crises forced people to remember their power. But now, the Fed's own plan appears to be positioning them not just as alternatives, but as anchors for a new monetary landscape. Bart, a veteran voice in the precious metals space, has been sounding the alarm, and this time, the alarm is deafening. Gold is no longer creeping up, it's surging. Silver isn't just catching up, it's threatening to break free entirely, and this isn't happening in a vacuum. Behind the curtain, central banks have been accumulating physical gold at levels not seen in half a century, while retail investors scramble to secure what little silver remains in circulation. The narrative is changing, and it's happening fast. For years, policymakers dismissed the role of precious metals, insisting that the dollar, supported by policy tools and faith in central banking, was unshakable. But when faith erodes and debt explodes, the story flips. That's what we're witnessing. The leaked details point toward a fundamental reshaping of how gold and silver are priced, traded, and recognized in the financial system. The phrase "gold standard 2.0" has begun circulating among insiders, though officials are careful to avoid admitting it outright. If true, this would mean that after nearly a century of fiat dominance, we're on the edge of a forced return to hard assets underpinning global trust in money. Imagine the implications. The $34 trillion U.S. national debt isn't just a number, it's an anchor weighing down confidence. Interest payments alone are ballooning beyond sustainability. And when the world no longer trusts paper promises, they demand something tangible. That's where gold and silver come in. Bart points out something most people ignore. Silver is the fuse. Gold is the bombshell, but silver is the match that lights the fire. Historically, whenever gold enters a strong bull market, silver doesn't just follow, it outpaces. In the 1970s, during the last great inflationary storm, silver's gains dwarfed gold's in percentage terms. In 2011, silver ran to nearly $50 an ounce, while gold was hovering around $1,900. Today, gold is already breaking record highs, but silver hasn't even awakened fully. That means the catch-up phase is coming, and when it does, the move will be violent. The leaked Fed plan reportedly involves mechanisms that would indirectly tie portions of reserve assets to gold valuations, perhaps through restructured SDRs or through backdoor settlement requirements. If confirmed, this wouldn't just legitimize gold as money again. It would catapult silver into the spotlight, since historically, silver has always been the more accessible metal for mass adoption. Everyday investors can't afford multiple ounces of gold at $3,800, but they can still grab silver at under $50. This accessibility could ignite a frenzy unlike anything we've seen in modern markets. And the timing couldn't be more perfect or more dangerous. The dollar index has been sliding, signaling waning global confidence. Inflation, despite official claims, remains sticky. The Fed has cut rates, yet liquidity crises appear in different corners of the economy, like brush fires breaking out in dry fields. Every move to patch one area sparks instability in another. For the average saver, it's chaos. For the central planners, it's desperation. And for gold and silver, it's the ultimate setup. The most astonishing part of this leak is not just that gold and silver could surge, but that their surges may no longer be capped by the same manipulation and paper games that have suppressed them for decades. Futures markets, derivatives, and naked shorting have long distorted real price discovery. But as physical demand overwhelms available supply, these paper games collapse under their own weight. Bart emphasizes that when delivery fails, when investors demand metal, not contracts, that's when the real fireworks begin. And according to insiders, those failures are closer than most imagine. Now, here's the question that matters to you. Should you be buying right now when prices are already running hot? The fear of missing out is real, but so is the fear of buying at the peak. Yet history shows that in seismic shifts like this, the peak you see today becomes the floor of tomorrow. Gold at $2,000 once looked expensive. Now people wish they had bought more. Silver at $25 looked overbought not long ago. Today, investors are scrambling for ounces at nearly double that. The psychology of scarcity kicks in, and that psychology becomes self-fulfilling. Think of it this way. If gold were revalued even modestly to reflect current debt levels, we wouldn't be talking about $4,000 or $5,000 per ounce. We'd be talking about $15,000, $20,000, or higher. Silver, historically tied to gold at ratios of 15 to 1 or 20 to 1, would follow in kind. Even at a conservative ratio of 40 to 1, silver could easily sit in the hundreds per ounce. The math isn't wishful thinking, it's cold arithmetic when debt, currency debasement, and demand collide. And this isn't just a Western story. Look east. China and Russia have been aggressively stockpiling gold, not out of luxury but necessity. They know what's coming. They've lived through currency collapses before, and they see the writing on the wall for the dollar-centric system. The Middle East, flush with oil revenues, is diversifying wealth into tangible reserves. Even African nations, often overlooked, are revisiting their resource bases as bargaining chips in a shifting global order. Everywhere you look, hard assets are being revalued. Not in some distant future, but right now. This is why Bart brands insist the leak is not a rumor to ignore, but a signpost. The Fed may never announce we're going back to gold, but their actions are louder than words. Market participants smell it. Central banks confirm it, and investors who wait for the official press release will find themselves priced out. The window to act is closing, and once closed, it doesn't reopen until prices are multiples higher. The shock factor here isn't just about numbers on a chart. It's about trust. Money at its core is trust. Every dollar bill, every bank account balance, every digital number flashing on your phone is a promise. The moment people lose faith in that promise, collapse begins. And history has shown us, over and over again, that when paper promises fail, humanity runs back to metal. It's in our DNA, etched through centuries of crises. When Rome debased its coins, citizens hoarded silver. When Weimar Germany collapsed, those who had gold survived while others starved. In the 1970s, when inflation ripped through America, the only protection for savers came from gold and silver. The pattern never changes. What changes is the scale, and today's scale is bigger than anything we've ever seen. That's why this leak about the Fed matters so much. It isn't simply a policy adjustment, it's an admission of weakness. For decades, the Federal Reserve has projected strength, control, and mastery over the economy. Interest rate adjustments, quantitative easing, forward guidance. These tools were designed not only to move markets but to shape perception. The perception was always that the Fed had things under control. But if they're quietly preparing to reposition gold and silver, it tells you one thing. They know control is slipping. The machine is breaking down, and they're scrambling to build a new one before the old one crashes completely. Bart Brands explains it like this. Imagine a dam that's been holding back an enormous river. For years, cracks appear, but engineers patch them up. Leaks form, but emergency crews arrive. The public is told, don't worry, the dam is strong. But behind the scenes, the pressure builds. Then one day, word leaks that the engineers themselves have started building a backup structure downstream. That's the signal that the dam is doomed. That's exactly where we are in the monetary system right now. And here's the terrifying twist. Once that dam breaks, there's no slow motion unfolding. It's instant. Prices adjust violently, not politely. Gold doesn't climb $50 at a time. It gaps hundreds overnight. Silver doesn't move from $30 to $35 gradually. It rockets to $60, pauses, then explodes past $100 before most people even understand what's happening. These aren't dreams. They're the dynamics of a panic-driven repricing event. Consider supply. Silver is not just a monetary metal, it's also an industrial lifeline. It's in solar panels, medical devices, electronics, batteries, and every new green technology you can name. Global silver demand has already been running ahead of mine supply for years. The gap is plugged by recycling, but even that cushion is thinning. If financial demand surges at the same time, industrial demand keeps growing, the shortage becomes a crisis. That's when premiums skyrocket, shelves empty, and physical silver simply vanishes. Try explaining to the average citizen why silver coins are unavailable at any price, while headlines scream about new record highs. That panic loop feeds itself. Gold, on the other hand, doesn't get consumed the way silver does. Almost every ounce of gold ever mined still exists, sitting in vaults, jewelry, or hidden reserves. Yet even gold is under pressure because it's being absorbed by central banks at a pace not seen since the end of the Bretton Woods system. Why? Because they're preparing for the new game. They see the dollar's diminishing power and they're quietly shifting to gold as the insurance policy. If the Fed itself is aligning policy in that direction, the message couldn't be clearer. Gold is money again, whether they announce it or not. But here's something most analysts don't talk about. What happens to everyday people during such a shift? When currencies wobble, prices of everything rise. Groceries, gas, rent, it all climbs. Paychecks don't keep up. Savings accounts melt. The middle class gets squeezed hardest. But those holding gold and silver not only protect their purchasing power, they often see it multiply. During the 1970s, while inflation devoured wages, gold holders watched their wealth explode. The same script is playing out now, just on a grander scale. The leak is your warning shot. It's not a headline to skim, it's a lifeline to grab. Now let's think globally again. Imagine you're in Asia, where trade is increasingly being settled outside the US dollar. China and Russia are already experimenting with settlement mechanisms backed by gold. Middle Eastern nations are whispering about oil contracts that bypass the dollar entirely. If the Fed makes a move that even hints at tying value back to precious metals, it accelerates that global shift. The world no longer needs to pretend that fiat is stable. They'll pivot fast. And when they do, trillions of dollars worth of demand will reroute toward gold and silver. That demand will dwarf anything retail investors in the West could imagine. Bart Brands doesn't mince words. The moment the leak is confirmed by action, we're no longer in a bull market. We're in a revaluation. That's the difference. A bull market is gradual, speculative, and measured. A revaluation is violent, structural, and permanent. After it happens, there's no going back. Gold at $10,000 doesn't return to $2,000. Silver at $200 doesn't fall back to $25. Those levels become history, etched like the $35 gold peg of the old Bretton Woods era, something future generations look back on with disbelief. Think about the psychology of that moment. People who laughed at gold bugs, who dismissed silver stackers as fringe, will suddenly be the ones begging for access at any price. Governments that ridiculed hard money advocates will be scrambling to secure reserves. Media outlets that ignored metals will be running daily segments on prices, and by then, the opportunity will be gone. That's how revaluations work. They reward foresight and punish hesitation. So, what does this mean for you sitting here now? It means the clock is ticking. The leak tells us that insiders are already moving. By the time confirmation comes, the first major moves will have happened. That's why you act before the headlines, not after. And this is not investment advice. It's common sense survival strategy. You don't wait until the storm hits to buy insurance. You secure it while the skies are still deceptively calm.